This will be available as a podcast under the Lead Lag Live banner. And any kind of help in spreading the word is always much appreciated, given that I do this entirely on my own. This is going to be a really good conversation. I spent the last half an hour reviewing some of Juliette's research. I think a lot of you will find it really intriguing in terms of the way that she looks at the world. My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Juliette Declercq. Juliette, a lot of smart people that I follow you. That's how I came across your profile. Introduce yourself to the audience. Who are you? How'd you get interested and involved in the economy, in markets, and macro, and what are you doing now?
Hi, so my name is Juliette Declercq. I'm the founder and chief strategist at JDI Research. I've got about now, unfortunately, 24 years experience in investing. And I work chiefly with investors and traders ranging from, hedge funds, real money, family offices, and high net worth. Try and focus on the underlying trends, allowing my clients to be able to trade the underlying trends and get away from the noise, which obviously has been a massive challenge this year, which has probably been the noisiest in my whole career. And the second thing is that I work a lot with charts. So I'm really trying to never tell clients what I think, but really what I see and what I think is tradable. So I'm working a lot with clients on conviction rather than, sticking my finger in the air and being like, right, I'm bullish, bearish, or whatever. So I think that's really what really differentiates me from other macro analysts is that, I'm really a trader at heart, even if what I like and my passion is really about the narrative and getting the narrative right.
Okay, so you mentioned three interrelated things. You said underlying trends, speed, and noise. And I think it's fair to say that usually noise has a speed dynamic to it as well, right? The faster things are, the more apt it is to having more noise, less signal. Now, I'm curious to hear your thoughts on the way these trends have accelerated in their movement and what the implications are for most investors. I put out this tweet not too long ago, Juliette, that we're going through the fastest rate hike cycle in history, but seemingly people are not even considering the fact that means it could be the fastest to end as well.
I mean, for sure, it will be fast. When it turns, it will turn fast, and that's when something is the more obvious and the more against the underlying trend the turn is, and obviously the faster it comes. So we basically look at a turn for say 12 months and then sometimes it will turn in 3 days, which is why you obviously have to be very careful trying to call the turn. And here I'm obviously talking about the rate cycle in the United States. When things start to unravel, we could be 1-2% down in a couple of weeks. And that's why, so many are already keen to get back long duration, right now after the seemingly sort of soft pivot expected by the Fed at the next meeting and looking to, potentially drop down from 75 base point increments to potentially 50 and then 25. I'm still very much in the camp, and I've been all year in the camp that the biggest issue the world has right now is the strength of the US economy and not the risk of a recession. There's many ways to look at it, but I think what's really been a major trend and underlying trend to date, and I think it still is the case today, is the extreme resilience of the US economy. And obviously part of it is due to the COVID liquidity, which is still abundant in the US system.
One of the narratives that was often pushed out, especially towards the beginning of the year, was that much of the inflationary pressure was really due to the supply chain shocks, more due to commodities. And now the narrative seems to have shifted much more to it's really ultimately about the consumer. And you're kind of alluding to it with the strength of the U.S. economy. And there are lags, right, between central bank policy and the consumer even realizing what's going on in terms of the heightened cost of capital. At what point do you think there really would be a slowdown, especially when it comes to U.S. consumers? We see it in financial markets, but the real economy really hasn't responded just yet.
Yeah, exactly. I was just looking this morning. I mean, my main thing is really to look at charts, and unfortunately, I can't send charts to your listeners right now. But for example, one thing I'm looking at is SPX year on year versus the credit impulse, and with a 9 months lag. So, in other words, credit responds to like basically the tightening in financial conditions with about 9 months lag. And what you can see in this cycle, if you're just looking at the consumer, we've only just turned neutral on the credit impulse. If you're adding corporate loans to that, we only basically just dropped last month from a whole-time high in the credit impulse. And what's really interesting is that you see the turn in financial conditions and obviously in SPX as well. You only start to see it when the credit impulse basically has rejoined down, e.g., we still need to collapse from like around +4 right now to say like -4, -5. And we're not there yet. So really the main thing and the main difference between this cycle and previous cycle is really the fact that credit flows have been extremely resilient. And the reason and that's despite obviously the interest rate shock that's hit the US economy. The problem is that many have been looking at the interest rates in nominal terms, and I've been arguing that really the only thing that matter is real terms. So in other words, if your inflation expectations are still, let's say, around like between 5 and 7, according to which survey you're looking at, and I'm considering Michigan, New York Fed, and Conference Board on that, we're still basically between 5 to 7. If you're looking at like, the average mortgage rate, we just basically crossed above 7, which means that just a month ago, you still had negative real yields if you're actually looking at what consumers will be looking at to consider whether it makes sense or not to borrow. And what I want to say here is really that until 2 months ago, there was still like free money in the system, in the sense that, if you're saying, inflation is going to be 7% in the next year, then it makes every sense to borrow at like 5, 6, and, at 6.5. So free money has only just gone, which also explains why the credit impulse and credit flows generally have not dried out at all in the US. And for me, that's really the main thing that I would look at in terms of like a Fed pivot. I think you really need to see credit completely dry out and actually the credit impulse turning deeply negative. It leads growth by about like 3 months. So for me, that would be really a good sign to start looking in a definite top in yields and obviously like the start of loosening in financial conditions again.
Right, and that relates directly to credit spreads, right? So usually, while they've widened, they haven't widened to the extent that you would think, given the narrative conviction around recession, bear market, things slowing down. Spreads have, for the most part, not really blown out, suggesting mass repricing of default risk. So that I assume is very much related to that credit impulse point.
So one of my main where I've disagreed with consensus is, and I've got a lot of pushback, is on the fact that US will see a soft landing. And the reason, and that obviously rejoins to like, corporate spreads and also generally stocks as well. What I think is that the Fed will not be able and will not get to levels that are actually restrictive for the US economy. Inflation expectations are still running high. If you're looking at like the most dovish Taylor rule, and we've actually never in history, had a recession in the US unless you basically hit the most dovish Taylor rule. It's telling us right now that you need rates, Fed fund rates at 6%. Now, obviously, that will come down with inflation expectations, and maybe we're looking at like 4.5, 5.5. But at the moment, we're still basically, for the US economy, we're not at restrictive levels. And I think the problem is that for the rest of the world, obviously the Fed is not only the central bank for the US, but it's also the central bank for the rest of the world. And unfortunately, we're talking a completely different story in the rest of the world, which is the reason I believe that the Fed will not be able to get restrictive for the US, which means that actually I would be considering to pick up not only dollars, because I think, the real potential growth will be higher, much higher in the US than in the rest of the world, but also, US assets. And I am still very much looking for a US soft landing for that reason. And that reason is that we actually, because the Fed is too tight and US dollar liquidity is basically collapsing now at level. I think the last I looked, we were at like minus 11% year on year, means that we are actually getting much more likely to get hard landing in the rest of the world. But it's that dichotomy between where financial conditions should be for the US and where it should be for the rest of the world that will prevent the Fed, that will allow the Fed sort of like allow the Fed to pivot at levels that are actually still too low to push the US into a recession. So I would actually consider at this kind of like a level, I would actually consider getting into corporate spreads and corporate credit generally in the US. I think the US economy will avoid the worst.
Right. And it's interesting, right? Because dollar movement's a function of strength of the US economy, but also if it accelerates too quickly, I'd argue that's a sign of a sovereign debt crisis coming. And at least in the near term, it looks like maybe the dollar, Dixie index could have peaked. At least the momentum seems to have stopped. And I've made that argument before, Juliette, that if you cut off the risk of a sovereign debt event, that's enough to cause a relief rally in all risk assets. The U.S. may still do better from a longer term perspective, but presumably in that macro view, you're going to have very real tradable opportunities in the international areas which have gotten hit the hardest because of everything we've seen so far this year.
Yeah. So I think the sort of like mini dip in the US dollar is not only due to the sort of like soft Fed pivot, and I think we'll probably see that it's only just a superficial pivot, because a real pivot is when the Fed tells us they are done hiking or they're actually going to be cutting. What we've had is basically what is sort of like a natural, that you're not going to be keeping hiking by like 75 base point increments, but we still don't really have a terminal rate. So we haven't put a line in the sand there. And I actually think the terminal rate could still be higher than what's priced by markets right now. So we've had that's sort of like a mini pivot. But also we had a bit of a energy miracle in Europe, which is the fact that basically it's like until yesterday it was like between 25 to 30 degrees in France. And, today in UK, we sort of like dropped down to like 15 degrees. But, yesterday was still like t-shirts and it's basically almost November and it's like 25 degrees in the UK. So the heating season has started a lot later than usual, which is allowing some to, increase the chance that firstly, Europe could be avoiding the worst in terms of like gas rationing and in terms of the electricity crisis, but also in terms of like, the price of subsidizing electricity provisions to households in Europe is obviously dropping down. Earlier this week, we've seen like spot gas prices basically like trading negative because storage are completely full. I wish I could call that more than a temporary miracle, but unless it's basically going to be like 20 degrees plus for the whole winter in Europe and next year as well, I think this is nothing else than like temporary. And if temperatures drop back to sort of like normal, which is the current forecast, I think it's, we are going back to the sort of like doom loop. And the fact that, dollar strength is brilliant for the US. If you're looking at like Bloomberg commodity prices, in US dollar terms, you're basically at 2% now year on year, which will allow inflation in the US to collapse and PPI to collapse as well. So in the US, you've got like PPI running at like, I believe like 11% year on year. In Europe, if you're looking at like the commodity index in euro, you're actually still running like 24% year on year. And that's translated into PPI year on year growing at like 43% in Europe. So it's really a completely different game. And the problem is like, what's good for the US right now, e.g., lower PPI, lower commodity prices, lower headline inflation, which is actually started to translate into higher purchasing power in the US, and which I believe will strengthen consumption and means that that you will not see a collapse in US consumption in the next few months. Well, we have the exact opposite in Europe and Asia and the rest of the world, really, where supply side inflations are still growing. And, as long as you don't see demand collapse, that will continue to leak into CPI. So that's really the issue of like, you've got a virtuous circle in the US, which is actually a vicious circle in the rest of the world. And I think, unfortunately, that, the respite we got in terms of like sovereign debt, and as you say, less markets have been pricing less chance of sovereign debt issues. I think those issues will come back as soon as basically, it looks like, the respite we got on electricity and energy prices, goes away. And we're left with basically the world fighting for capital flows, higher interest rates in Europe, and at the same time, much higher risk of recession. So we actually had the debt to GDP ratio coming down quite dramatically from just the aftermath of the COVID crisis, and that was all due to inflation. Inflation is a great way to inflate away debt, and we had even in Europe like 9% plus nominal GDP growth. At that level of nominal GDP, you can basically finance debt easily. The problem arises when you can't grow in nominal terms higher than where rates are in nominal terms. So let's say, let's look at Italy right now, which has rates at like 4.5%. Well, Italy's done well in the past year in terms of like debt to GDP because, nominal growth was much higher than that. But we're now headed to recession, which means we're now headed to recession with persistent inflation stemming from like extremely high PPI, which is telling me that the debt to GDP ratio are actually going to start to deteriorate again, with the risk, as we've seen in UK just 2-3 weeks ago, that bond vigilantes prevent any kind of like resorting to like fiscal stimulus, which would be the normal way Europe or UK would deal with a recession. And that's why I'm talking about the risk of deflationary depression in the rest of the world versus a US soft landing.
It's interesting in hearing that, and I saw this in your report, which, by the way, those that are curious should check out JDI research. You mentioned the relationship of small caps to long duration treasuries, and one of the things that I've kept on hammering the last month or so, as I said, the end of the world is at hand. That's why stocks are about to have a melt up. Is that the breadth this time around in the smaller stocks, which are more sensitive to the U.S. economy, is really improving in a pretty dramatic way. I mean, you're seeing, this leg higher on like the June-August mini run there being led by much more of, I would argue, the right types of names. So while everyone is still focused on the large cap multinationals having poor earnings, especially on the tech side, beneath the surface, again, at least for a moment in time, that argument around the consumer, U.S. economy strength, that actually very much explains, I think, this burgeoning momentum we're seeing in small caps.
Yeah, I mean, obviously, like sentiment, it's almost to the day. If I'm actually like looking at like the DSI and like 5-day around like everything risk on in the DSI, and we literally hit below 5 the day before we started to see that what many call the Fed pivot and basically like 10% upside in equities globally. So I think there is definitely still space And that would be the way I would be looking at things is continue to buy risk dips on really depressed sentiment. But I don't think it will be a home run from there, and I would actually expect to retest the lows.
Yeah, and this year Treasuries have acted worse than equities in their drawdown, but it would be it would be nice if you have a relief rally across the board, which surprises everybody given how one side the bearishness is, and then the return of, let's call it, real risk off, which would be more consistent with a financial crisis, global recession, whereby rather than the risk off sentiment just being centered around a strong dollar, it actually this time manifests with lower long duration yields, which is what's been so unusual about this year.
Yeah, I mean, you're basically talking about a return of like risk parity strategies. And
right, exactly. And by the way, I'm glad you say it because risk parity has gone through a horrendous decline too. The same dynamic has very badly hit risk parity.
Yeah, but unfortunately, I think we're still a bit early in there, and that takes me back to what I was talking about before. I think we really need to see credit collapse in the US before you can call, unless we see like major financial instability in the rest of the world. I think you're still a fair way away from terminal rate in the US, and I would not think that the Fed pauses before Q1 next year, which means that I think we will see another run in the dollar, so dollar up, and also, I would expect risk to have another down leg as well. So, I'm actually looking to buy down leg in risk and stay long dollar.
Let's go to some of the audience. Go ahead.
So, I mean, the way I work is I don't look at different scenarios. I look at the best possible risk reward in terms of like trade advices. So, that I'm looking at what I see and basically try to get like a really high risk reward in terms of like trade recommendation. I don't work as an economist and, telling you, I see 20% chance of this and 50% chance of that. And what I look at is like, look, I think there is like a, say, 50% chance of that, and we are priced at like 10% chance, and therefore it's a good buy or it's a good sell. Is that making sense? And also, like giving this year, maybe any other year I would be like, what be my guess? I'll give you some percentage chance anyway. But this year we've had like a, between sort of like the Russian-Ukraine war has been a major, input into macro. And obviously, you can spend all day long looking at it. You still wouldn't really have a clue what Putin's next move will be. I think one major game changer we had last month, which has made me initially more negative on Europe until we had that span of like a better weather, is basically the blowing up of the pipelines. So in the Nord Stream pipelines. What we had until then was a chance that basically under economic duress, and I'm talking obviously the main one is Germany, that, Europe would sort of like give in the sort of like, Donbass, given on helping Ukraine on the Donbass, the war in Donbass, and that would sort of like lead Putin to basically restart gas deliveries, and I think that would be quite likely to happen even if it wasn't sort of like openly, but like sort of like governments striking their own deals and starting to pull in that direction. Actually, the same way like Americans are less and less supporting the help that US has been giving to Ukraine as well. But obviously, whoever blew the pipeline has sort of like cut out that option because the pipelines are blown terminally, and that means that you've basically cut out the option of Germany striking a deal with the US and sort of like diminished dramatically the chance that Europe/UK would be giving up on or at least lowering their help on Ukraine, which was obviously Putin's wish. So, you've got things like that you just literally cannot put a percentage probability on. And you basically have to be on the deck all the time, revising, between what is potentially a game changer or not a game changer. And for me, that was really very much a game changer. So yeah, this year has been a lot about geopolitics, which is extremely difficult to put a risk on.
Let me reset the room. Everybody, please make sure you follow Juliette Declercq here on Twitter and check out her phenomenal research as well. I spent time looking at a report that she sent, very well thought out. Again, this is Michael Gayed, publisher of the Lead Lag Report. Juliette, I want to get your thoughts on something I've been thinking about myself for several weeks here, which is gilt and mark-to-market accounting. And I say that because if you remember back in 2008, there was, and I think there's some validity to the idea that part of the reason we had the financial crisis was because of mark-to-market accounting, where suddenly assets which were illiquid were getting more visibility, which resulted in panic, right? And I often wonder if you had mark-to-market today on a global scale, given what we saw with the UK, if it would look very similar, if not worse, in 2008. Talk us through just the UK crisis and the idea of it maybe being more than just the UK.
I mean, there is no question that it will be just about the UK. I think there is the risk that banks used to hold and that is a lot lower today than before the global financial crisis because of regulations has definitely shifted to like what you could call like shadow banking, whether you're looking at like insurance, whether you're looking at any sort of yield enhancing vehicles that have been basically running wild in Europe and linked to real estate, obviously corporate real estate as well. And I've got absolutely no question about the fact that if you had to actually mark to market all of this on the sort of like scale that you had to do it in the UK, which is basically like a tripling of medium-term gilt rate over a couple of like weeks, that you would run into financial instability. The interesting thing is the US is, I think, again, and that's the problem, is that the US is probably the most shielded. Mostly people borrow there on fixed rate. If you're looking at like debt servicing ratio in the US, you were basically at all-time lows at the end of the COVID crisis. But the rest of the world is looking a lot different. If you're looking, you consider Canada, you consider Australia, you consider the UK. There's a much larger share of floating rate, held by households, and also much higher private debt to GDP ratio. So, and that's not even talking about, what would happen if you actually had to consider each loan on its own rather than aggregate basis, which is basically, what happened during the global financial crisis, when, it's not only just about aggregates, but also about like the absolute level of leverage in economies. I think it's really difficult to quantify and to know where what naked strategy is going to pop out next. But I do have no question in my mind that we will see, and I think it's only just the beginning, because if you have to consider the fact that employment, we're still at full employment in Europe and US. So nothing has really been tested. So far, we have like higher rates, but we still also have like really high nominal growth, which means that there isn't much of it for bond vigilantes to really test economies, the same way we've seen it happen in the UK yet. But the next few months could actually bring the reality of recession combined with higher rates. And again, that's when you really have to start worrying about debt to GDP ratio and debt sustainability. And my view is that at that point, central banks will have to consider the risk of like, the fact that inflation is not a linear function. You basically just need one event for like, inflation returning to 2, actually like plunging below 0. So at some point you will be talking about risk of deflation, or basically letting inflation run a bit longer. And I think for now, really, it's all like a political a political choice. And I think clearly, whether you're looking in the US or Europe, the political choice is still very much to tame inflation, and that there's been no compromise because we're still at full employment. So I think central banks will continue to, be hawkish and really like try and ram inflation down. But there will be a point next year where that will basically trigger financial instability, and where political choice will switch from inflation to unemployment. And that's the time where you have to, again, the risk that fiat currencies will be devalued once again, starting in economies that are the most vulnerable. And I'm talking about Europe, I'm talking obviously about China, I'm talking about UK, Australia, Canada. And our issue here is that, fiat devaluation is a lot less painful when, everybody's doing it. And, you buy gold and you buy crypto, and you barely see anything. Your money is taken away from you, your purchasing power is taken away from you. But it's less obvious than when the Fed is actually still keeping the dollar strong because the US economy is doing well, and you see your currency devalued against the dollar. So I'm looking potentially at like another 20% depreciation of euro, sterling versus the dollar, and like really the dollar coming up another like 20% higher.
By the way, I would add that point you mentioned about inflation going to zero or outright deflation below it. You pretty much have to have that if you're going to go back to a long run average of 2%. I think it's interesting that people seemingly are forgetting that if you're going to have mean reversion in inflation expectations, that means you have to go past the mean, right? You have to overshoot.
And it's obviously a really interesting point you raise here, because if you consider the fact that inflation is a lagging indicator of like 12 to 18 months, think about how much liquidity was necessary to bring inflation up to like 8%, and the fact that that liquidity is basically shrinking as fast. But we're actually just now thinking that it will be bringing back inflation to like 2%. It's not how it works. At some point, that liquidity shrinkage will basically feed through directly into the economy, and the risk will become deflation, at least as far as the goods and commodities are concerned. That should actually take me to the view on core inflation and the labor market, which is also really important for the Fed. I think many macro pundits are looking at wages the wrong way. For me, wages is wage growth is a combination of like hitting full capacity, but also, and that's one thing that's not considered enough, is inflation expectations again. So what drives wage growth is, the fact that we've hit full capacity, and for the first time in history in the US market, but also the fact that it was in time of really high headline inflation. So you're looking at headline, you're looking at the fact that everybody wants you to work for them, and you're basically demanding, say, like 7-8% wage growth. But if you're looking at the real linear function of wage growth versus labor capacity, what you should be really looking at is real wage growth. And if you're looking at real wage growth, then it is a linear function, and you're basically getting from like 0% zero wage growth before the COVID crisis to currently like 1% wage growth. So again, this is really telling you that if we just lose a little bit of capacity on the labor on the labor force, whether it's going to be with less job availability or slightly higher unemployment rate, and also lower headline, which in the US looks like it's very possible, because headline inflation will be driven by commodity price growth year on year, which in the US is currently like around 2%. And you will basically I think you will see wage collapse to like say 4.4 to 5%, which would be then in line with the 2% target much faster than many currently expect.
Go to for a question. Sorry.
I mean, at the moment, what's really interesting in Europe, and it's not dissimilar to what's happening in the US, is that the credit impulse has actually not come down at all. And it's been driven by corporate borrowing. Corporate borrowing basically looking to subsidize PPI, and basically in Europe, many corporates are seeing the current crisis, if you want, as temporary, in the sense that they are borrowing to keep for basically working capital to finance inventories, and obviously inflation is allowing you to, if you keep just nominal wage like low with inflation of like 10%, you're basically able to bring your labor costs down without actually shedding any workers. So, that's what's happening right now. If you're looking at the last ECB lending survey, which came out just at the beginning of this week, you can see that lending standards will be tightening dramatically, including for corporates in coming months, and that we might be looking at a completely different picture in Q1 next year in terms of employment. But right now, pretty much whether you're looking north, south, or in France, many countries are in terms of employment as well as they've been in the whole euro area.
You had mentioned, Juliette, that you're going to at some point have economies tested, and I brought up this idea for a while that I think we're probably going to see a return of what happened in 2011, right, with the pigs and the credit spreads blowing out. I know you've written about the Italian bond market a bit. Talk to the audience a little bit about how some of these peripheral high debt economies in Europe, how's the ECB going to respond to that choice of fighting inflation when they really just have one blunt tool?
Yeah, I mean, that's the main difference between the sovereign crisis of like 2011 and today. The problem today is that central banks' hands are completely tied. So you have a choice between sort of saving peripheral spreads by returning to QE. The new tool, the new TPI tool, basically the ECB has said that it would be sterilized, which means that if you're buying Italian bonds, you will have to somewhat sell bonds. The problem is the electricity crisis, the energy crisis is euro wide, and it's not a specific peripheral issues that we're talking about today. And I don't see whatsoever how, when markets are going to be testing the TPI, and because there is no question in my mind that markets will be testing the resolve of the ECB, and that would probably be at a 300 basis point spread between Italy and Germany, which, I think we've moved as high as 260 basis points recently. But obviously the mild weather in Europe has given us respite there. So at some point, we will be in recession with rates still high, because there is a huge inflation pressures stemming from 43% PPI, and still that will be leaking for a long time into CPI, which means the ECB will have its hands tied, and we'll have to make a choice at some point between inflation and unemployment. Again, we haven't had to make that choice yet because employment's been really strong, but 2023 will be about central banks being tested on their credibility. And I think once the ECB will be tested, the Bank of England will be tested, and eventually what will be chosen is a longer span of inflation rather than the risk of a liquidity trap, because that's what will happen really, is like a liquidity trap where you've got high rates and a debt crunch, which basically, so for me that's really the main difference between today and 2011 2012, is that in 2011 2012 you could do as much QE as you want, and of course that's in hindsight, but we always knew that the end game for QE and the end game for being able to save the periphery and in a way save the euro as well is basically inflation, and we have inflation today. It's probably here to stay, and that's the most worrying I've been for the eurozone in my whole career, especially with France disagreeing with Germany on subsidizing energy. You basically have internally more and more divergence, fiscal divergence, with basically Germany claiming that they've got low debt to GDP and therefore they should be able to subsidize energy, when a country like Italy can't subsidize on energy on its own.
How should one consider allocating given this kind of backdrop, right? I mean, is it, you kind of alluded to, right? At some point, you're going to have devaluation, crypto, gold, risk assets, presumably. But if there's another, looming financial crisis, which maybe is just being a bit delayed for now, is it going back to the old playbook of prior financial crises, or would the dynamics result in a very different opportunity set to think through investing in?
So I don't think there will be another a global financial crisis, because I think we will have to choose fiat devaluation and like higher inflation rather than basically credit crunch and deflationary depression. So just to be clear, I think we will see a higher risk of a global financial crisis. We will see financial instability. I don't know where they will pop, but eventually that will lead to basically continued fiat devaluation, which means, like savers are going to be continuously screwed, and, like retirees as well. But that's the only path forward, unless you believe that global financial crisis is an option that politicians will choose. In the end, we still have a choice, right? And I think during the GFC there was not much of a choice, or maybe everything unraveled too quickly, and there wasn't the sort of like a QE miracle, or liquidity unleashing. Liquidity wasn't unleashed fast enough, but I think like financial authorities are already on deck wherever you look in the world, and you can see how fast the Bank of England was to basically, when they were just about to start QT, they actually restarted QE. And okay, maybe it was just temporary, but then the only reason why QE didn't have to like continue beyond like deadline, which actually is tomorrow, is because suddenly fiscal authorities made a massive U-turn.
Yeah, no, that makes a lot of sense. Again, everybody here, please make sure you follow Juliette Declercq and check out her research. You've mentioned before in your report, Juliette, this concept of stealth monetization. And since we're talking about QT, I'm not of the mindset that we will ever get out of the balance sheet game, because the numbers are too large, right? And everyone keeps on assuming that QT is going to be continuous and this is going to be the real pressure. But
no way,
yeah, let's talk through the complications of that, because I think these narratives need to be countered a bit.
Yeah, I mean, stealth monetization is where we're going. I don't think central banks are going to be telling us with inflation still above 5% that they're returning to QE. But, what we've seen in UK is just like sort of like temporary liquidity. I mean, they'll find all kind of names. You probably remember, like, what was it, like end 2019 when the Fed returned to QE, and we all called it like a non-QE. So yeah, I don't expect that we'll see like a return to QE, but we will see liquidity return via different tools that will be called financial stability. Like the sort of like, let's talk about the ECB. They've actually said that TPI would be sterilized, but it would take just probably like erasing one line to basically make TPI the new sort of like a QE option, where you're basically buying Italian bonds and you're not actually selling German bonds, right? And of course, that would be illegal. But what's legality in finance these days? In the end, I think what we've learned in the past 10 years is that in the end, like central banks just do what's needed for financial stability to remain. And financial stability will be a much more important goal than bringing inflation back below 2% quickly.
Aside from the U.S., are there any other parts of the globe that look interesting from a macro perspective in the years ahead? I mean, I've done a couple of spaces with people that talk about India, and I actually think the thesis around India is quite strong. But I'm curious to hear your thoughts when you look out, globally, aside from U.S. markets and maybe some selective trading opportunities with Europe. Anything else that's interesting to you from a valuation perspective, from a macro perspective?
I always try to find some what I would call like beta options when alpha is not that interesting. But unfortunately, this year there is everything will be about alpha, right? Everything will be about. Sorry, I'm talking about beta alpha. I should be saying I'm always trying to look for alpha when beta is sort of like boring. But at the moment, there is nothing more important than to call the Fed right. and to actually see when the terminal Fed funds will be sort of like set in, and there will be a line in the sand, and then you'll be able to buy whatever. And probably like the most distressed asset will make you the most return. So we're still very much in a beta world, and unfortunately, I haven't had time to spend enough time on alpha. Obviously, Brazil, Latin America has been interesting. I still want eventually to go back long commodities, which means, when you decide that USD liquidity returns, then I think there will be interesting opportunities in emerging markets for sure. That's the really best asset, and part of the reason is obviously massive, bows in China, real estate, and that's not going away anytime soon. But I think that's basically kept the emerging markets discounts wider than would be warranted, and I think we probably will see like huge opportunities when the Fed is done. But unfortunately, I don't think the Fed is done yet. It might take another 3 to 6 months. And in the meantime, I'm really going to spend all energy I have and all hours in really trying to get the big picture right. And obviously, once I get the big picture right, I'll have time to start thinking about alpha and, stories outside the Fed. But for the last, literally, like JDI research has been like 7 years. I started in 2016, and I've been able to like call everything, including oil, by just getting the Fed right. If you got the Fed right in the last 7 years, you basically got all assets right.
Yeah, I think that's unequivocal. It's funny you mentioned distressed assets, and the biggest returns tend to come from distressed investing. The odd thing this year is that the distressed asset has been government bonds. I mean, you can argue to some extent. I mean, gilts were the ultimate distressed play, something we've never really seen before. I mean, a public sector. Keep going back to this point. A public sector crisis is a very different dynamic than private sector crisis. So those that are in power will bail themselves out, which is why a lot of these narratives probably are not going to come to reality in terms of the real negative bearishness that's been out there.
Yeah, I mean, at the moment, the public is all, and politics are all about what will get them elected. And at the moment, the only thing the public cares about is inflation. But once they start losing their job, jobs is going to be the most interesting, the most important thing, and politics will shift, and that's when you're going to see credibility, central bank credibility at risk, because you're really going to get the political pressure growing. We're not there yet, but I think that's what 2023 will be really interesting, because there will be massive compromises to be made between inflation and employment, and it's all about getting the shift in the public about what their main concern is and how the next government will be elected.
Very well said. Again, everybody here, please make sure you follow Juliette. Juliette, really do appreciate your knowledge. I'm very much impressed with the way that you think about the global landscape, and thank everybody for joining. Thank you, Juliette.
Thank you very much for inviting me, and please get in touch if you would like to know more about JDI research. My website is jdiresearch.com. Feel free to take a look and get in touch if you want to cooperate in the future.
Very good. Thank you, everybody. Cheers.